I'm going to tell you something that nobody wants to hear. Something Wall Street doesn't want you to know. Something your financial advisor probably hasn't mentioned. The market is setting up for a crash, not a correction, not a healthy pullback, a crash. And your 401k, your IRA, your retirement savings that you've spent decades building, all of it is sitting directly in the blast zone. I'm not saying this to scare you. I'm saying this because I've studied market cycles for over 30 years. I've analyzed every major crash in modern history. And what I'm seeing right now, the patterns, the data, the behavior, it's all pointing to something catastrophic. And most people have no idea it's coming. Let me start with the basics. I'm not a market cheerleader. I'm not someone who gets paid to tell you everything is fine. My entire career has been built on seeing what others refuse to see. In 2005, I started warning about the housing bubble. People thought I was crazy. By 2006, I was betting billions of dollars that the mortgage market would collapse. Everyone on Wall Street called me insane. They said I didn't understand how the market worked. They said housing prices never go down. And then 2008 happened. The housing market collapsed, banks failed, the entire global financial system almost went under. And the people who called me crazy suddenly wanted to know how I saw it coming. Here's the truth. I saw it because I looked at the data, not the stories Wall Street was telling, not the narratives on financial television, the actual data. And when you look at data without bias, without hope, without the need to believe everything is going to be okay, you see reality. And reality right now is terrifying. We're living through the biggest everything bubble in history. Stocks are overvalued by almost every metric. Bonds are in a bubble. Real estate is in a bubble. Even cryptocurrencies, which were supposed to be an alternative to the traditional system, they're in a bubble too. Everything is inflated, everything is overpriced, and when everything is a bubble, everything crashes together. Let me explain what's happening with your 401k specifically. Most people think their retirement account is diversified. They think because they own a mix of stocks and bonds, they're protected. But here's what they don't understand. That diversification is an illusion. When I look at what's actually inside most 401k accounts, I see the same handful of companies over and over. Apple, Microsoft, Amazon, Google, Tesla. These mega cap tech stocks are now such a huge portion of the market that you can't avoid them. Even if you think you're diversified, you're not. You're heavily concentrated in a small group of companies that have gotten ridiculously expensive. And it's not just tech stocks. The entire market is being propped up by a handful of names. The top 10 stocks in the S&P 500 now make up over 30% of the entire index. That's never happened before. Never. In a healthy market, gains are broad-based. Lots of different companies are doing well. But right now, the market is being carried by a tiny group of stocks while everything else is struggling. That's not strength, that's fragility. And when those top stocks finally crack, the whole market is going to come down with them. Then there's the bond side of your portfolio. For decades, financial advisors have told people to keep a portion of their retirement savings in bonds because they're safe. They're supposed to be the stable part of your portfolio that protects you when stocks go down. But bonds are not safe right now, not even close. Interest rates have been artificially suppressed for over 15 years. Central banks around the world have been buying bonds, printing money, doing everything they can to keep rates low. And all that manipulation has created a massive bubble in the bond market. Here's the problem. When interest rates rise, bond prices fall. That's just math. And rates have nowhere to go but up from here. They've been near zero for so long that any normalization of rates is going to destroy bond portfolios. And that's exactly what's starting to happen. We've already seen bond funds lose 20, 30, even 40% of their value as rates have started climbing. But most people don't even realize it because their statements just show a dollar amount. They don't show that the purchasing power of that dollar amount has been destroyed. Now let's talk about what's really going to trigger this crash. It's not going to be one thing. It never is. Crashes happen when multiple problems converge at the same time. And right now, we have more problems converging than I've ever seen. Problem number one, corporate debt. American companies have borrowed more money than at any point in history, over $10 trillion. And a huge chunk of that debt was borrowed when interest rates were basically zero. Now those companies have to refinance that debt at much higher rates. Many of them can't afford it. We're already seeing an increase in corporate bankruptcies, and it's going to get much worse. Problem number two, commercial real estate. This is the silent crisis that nobody's talking about. Office buildings are empty, shopping malls are dying, and all of those properties are financed with debt. Billions and billions of dollars of debt that's coming due. Banks that lent money for these properties are going to take massive losses. And those losses are going to ripple through the entire financial system. We're already seeing small and regional banks fail because of their commercial real estate exposure. But the big banks have the same exposure. They're just better at hiding it. Problem number three, consumer debt. Credit card debt just hit a record high. Auto loan defaults are rising. Student loan payments are restarting after years of forbearance. The average American is maxed out. They've been living beyond their means for years, using debt to maintain a lifestyle they can't actually afford. And now the bills are coming due. When consumers stop spending, the economy contracts. And when the economy contracts, corporate earnings fall. And when earnings fall, stock prices crash. Problem number four, government debt. The United States government is now over $33 trillion in debt. The interest payments on that debt are becoming unsustainable. We're spending more on interest than we spend on defense, more than we spend on most government programs. And as rates stay elevated, those interest payments are going to consume more and more of the budget. Eventually, something has to give. Either taxes go way up, or spending gets cut dramatically, or the government prints massive amounts of money and destroys the currency. None of those options are good for your retirement savings. Problem number five, geopolitical instability. The world is more unstable than it's been in decades. Wars, trade tensions, political chaos, supply chain disruptions. All of this creates uncertainty, and markets hate uncertainty. When investors get scared, they sell. And when everyone tries to sell at the same time, prices collapse. Now here's what most people don't understand about market crashes. They don't happen gradually. They happen suddenly. One day everything seems fine, the next day panic. In 2008, Bear Stearns went from being a prestigious investment bank to bankrupt in a matter of days. Lehman Brothers collapsed over a weekend. When the crash comes, it comes fast. And by the time you realize what's happening, it's too late to protect yourself. And this crash is going to be different from 2008 in a very important way. In 2008, the government could step in and bail everyone out. They could lower interest rates to zero. They could print trillions of dollars. They could do whatever it took to stop the panic. But they can't do that this time. Interest rates are already elevated because of inflation. If they cut rates and print money again, inflation will spiral out of control. But if they don't intervene, the crash will be devastating. They're trapped, and so are you. Let me tell you what's going to happen to your 401k when this crash comes. First, stock prices are going to fall. Not 10%, not 20%. We're talking about a 50% decline or more in the major indexes. Maybe worse. The tech stocks that have been propping up the market are going to get destroyed. They're trading at valuations that make no sense. When reality finally sets in, those stocks are going to fall harder and faster than anything else. And because your 401k is probably overweight in those names, you're going to take a massive hit. Second, your bond funds are going to lose value too. People think bonds will protect them when stocks fall. But if interest rates stay high or go higher, bonds will continue to decline. And if rates fall because the economy collapses, bond prices might recover, but the companies that issued those bonds might default. Either way, you lose. Third, and this is the part that really keeps me up at night, liquidity is going to dry up. When everyone tries to sell at the same time, there won't be enough buyers. Market makers will step back. Trading will halt. You might see days where you can't even access your account because the systems are overwhelmed. Or worse, you'll see your account balance, but you won't be able to sell because there are no bids. Your wealth will be evaporating in real time, and there will be nothing you can do about it. Fourth, the psychological damage is going to be severe. Most people have never experienced a real bear market. The crashes we've had over the last 15 years have been short-lived. The government stepped in quickly and propped everything back up. But this time, it's going to be different. The decline is going to last months, maybe years. And watching your life savings cut in half, then cut in half again, that's going to break people. They're going to panic sell at the worst possible time. They're going to lock in losses that they'll never recover from. And by the time the market finally bottoms, they'll be too scared to get back in. Now, I know what you're thinking. Michael, you've been predicting crashes for years, and the market keeps going up. And you're right. I have been warning about this for a long time. But here's what you need to understand. Just because the crash hasn't happened yet doesn't mean it's not coming. These bubbles take a long time to build, and they take a long time to burst. The housing bubble took years to inflate and years to deflate. This bubble is even bigger. It's going to take longer. But it is going to happen. The math doesn't work any other way. And timing is not the point. The point is preparation. If you wait until the crash is obvious to everyone, it's too late. By the time financial television is talking about crisis, your 401k is already down 40%. By the time your financial advisor calls you to discuss repositioning, the damage is done. The only way to protect yourself is to act before the crowd realizes what's happening. So what should you do? First, understand your actual exposure. Most people have no idea what they own. They see a 401k statement with a balance and they think that number means something. But you need to dig deeper. What percentage of your portfolio is in stocks versus bonds? What specific stocks do you own? How concentrated are you in tech? How much corporate debt are you exposed to? You can't protect yourself if you don't know what you're protecting. Second, reduce your risk. I'm not saying sell everything and hide under a mattress. But if your portfolio is aggressively allocated because you've been chasing returns, now is the time to dial it back. If you're 100% stocks because that's what's been working, that's insane. You need some defensive positions. You need some cash. You need some inflation protection. The goal right now is not to maximize returns. The goal is to survive what's coming. Third, consider alternatives to traditional assets. I'm talking about things that hold value when paper assets collapse. Real assets, commodities, gold, silver, farmland, water rights. Things that have intrinsic value regardless of what's happening in financial markets. Now, I'm not saying put everything into gold, but having some exposure to real assets makes sense when every financial asset is in a bubble. Fourth, if you're close to retirement, this is critical. If you're planning to retire in the next 5 years, you cannot afford to take a 50% hit to your savings. You don't have time to recover. You need to be extremely conservative right now. I don't care if it means missing out on gains. Protection is more important than growth when you're close to needing that money. Fifth, build cash reserves outside your retirement accounts. If everything crashes, you're going to need liquidity. You're going to need money to pay bills, to buy groceries, to survive. If all your wealth is locked up in retirement accounts that you can't access without penalties, you're in trouble. Have 6 months to a year of expenses in cash, more if you can. Sixth, prepare psychologically. This is going to be hard. Watching your net worth collapse is one of the most stressful things you can experience. People make terrible decisions when they're scared. They sell at the bottom. They panic. They do exactly the wrong thing at the wrong time. If you prepare mentally now, if you accept that a crash is coming and you game plan how you'll respond, you'll be much better positioned when it actually happens. Let me be very clear about something. I'm not trying to sell you anything. I'm not managing money. I'm not pushing a product. I have no financial incentive to tell you this. I'm telling you because I see what's coming and I think people deserve to know the truth. Wall Street is not going to warn you. They make money when you're invested, regardless of whether you make money or lose money. Your financial advisor is probably not going to warn you either because their job is to keep you calm and keep you invested. But I've spent my entire career analyzing data and betting on my analysis. And the data right now is screaming danger. Every metric I look at, every indicator I track, every model I run, they all point to the same conclusion. We are on the edge of a major financial crisis. And most people are completely unprepared. The housing crash in 2008 destroyed millions of families. People lost their homes, lost their savings, lost their futures, and that was just housing. This time it's everything. Stocks, bonds, real estate. The entire financial system is over-leveraged, overvalued, and on the verge of collapse. And your 401k is sitting right in the middle of it. I know this is scary. I know you don't want to believe it. But ignoring reality doesn't change reality. It just means you'll be unprepared when it hits. The people who survived 2008 were the ones who saw it coming and positioned themselves accordingly. The people who got destroyed were the ones who kept believing everything was fine right up until it wasn't. You have a choice right now. You can keep doing what everyone else is doing. Keep your 401k fully invested. Keep trusting that someone else is looking out for you. Keep hoping that this time is different. Or you can look at the data, look at the history, look at the patterns, and prepare yourself for what's coming. Because it is coming. The only question is whether you'll be ready when it does. The crash is not a matter of if, it's a matter of when. And when it happens, it's going to destroy unprepared portfolios. Don't let yours be one of them. Let me tell you about another dimension of this crisis that most people completely miss: the derivative exposure. When I was analyzing the housing market before 2008, what made that crisis so devastating wasn't just the bad mortgages. It was all the derivatives built on top of those mortgages. Credit default swaps, collateralized debt obligations, synthetic CDOs. The actual housing market was only a few $1 trillion, but the derivatives market built on top of it was tens of trillions. When the housing market fell 10%, the derivatives market imploded by multiples of that. We have the same structure now, but it's bigger. The derivatives market today is estimated at over $600 trillion. That's not a typo, 600 trillion. That's 10 times the size of the entire global economy. And all of these derivatives are interconnected. They're all linked together in ways that even the smartest people on Wall Street don't fully understand. When one part fails, it creates a chain reaction. And that chain reaction can take down institutions that everyone thought were safe. Your 401k might not directly own derivatives, but it doesn't matter. Because the banks that hold your money, the clearinghouses that process your trades, the market makers that provide liquidity, they're all neck deep in derivatives. When those markets seize up, everything seizes up. We saw this in 2008 when money market funds broke the buck. People thought money market funds were as safe as cash, and then suddenly they weren't. People couldn't get their money out. The entire short-term funding market froze. It took a government bailout to unfreeze it. This time, the derivatives exposure is concentrated in interest rate swaps. Banks and corporations have trillions of dollars in positions betting on where interest rates will go. When rates were near zero for 15 years, everyone got complacent. They built massive positions assuming rates would stay low forever. Now rates have moved violently higher, and all those positions are underwater. Some banks are sitting on hundreds of billions in unrealized losses on their interest rate swaps. They haven't had to mark those losses yet. They're hiding them on their balance sheets using accounting tricks. But the losses are real, and eventually they're going to have to recognize them. When that happens, we're going to see bank failures, not just small regional banks, big banks. Systemically important banks. Banks that everyone assumes are too big to fail. And when a major bank fails, the panic spreads instantly. People start pulling money out of other banks, the interbank lending market freezes, credit markets seize up, and suddenly your 401k can't trade because the entire financial plumbing has stopped working. There's also the issue of passive investing. This is something I've been thinking about a lot lately. Over the last 20 years, we've seen a massive shift from active investing to passive investing. People used to pick individual stocks or hire managers to pick stocks. Now everyone just buys index funds. Put money in an S&P 500 fund and forget about it. It sounds great in theory, low fees, broad diversification, set it and forget it. But here's the problem. When everyone is buying index funds, they're not making decisions about individual companies. They're just buying everything in proportion to its market cap. This creates a feedback loop. The biggest companies get bigger just because they're big, not because they're good businesses, not because they have strong fundamentals, just because they're in the index and money keeps flowing in. This has distorted valuations to an insane degree. Companies with mediocre businesses are trading at premium valuations just because they're large cap stocks that index funds have to buy. And it works fine as long as money keeps flowing into these funds. But what happens when the flows reverse? What happens when people start pulling money out of their 401ks? What happens when baby boomers start retiring and need to sell to fund their retirement? All that passive money that flowed in without thinking is going to flow out without thinking. And when you have trillions of dollars of forced selling, prices collapse. There's no one on the other side analyzing whether a company is actually worth buying at a lower price. It's just algorithmic selling, price insensitive selling. And that creates crashes that are faster and more violent than anything we've seen before. I also want to talk about inflation, because this ties directly into your retirement. The government tells you inflation is under control. They say it's at 3% or 4%. But anyone who actually pays bills knows that's nonsense. Real inflation, the inflation you experience in your daily life, is much higher. Food prices are up 20 to 30% from a few years ago. Housing costs are up massively. Insurance premiums are skyrocketing. Healthcare costs are out of control. Energy prices swing wildly but trend higher. So even if your 401k somehow avoids the crash, even if by some miracle you preserve the nominal value of your savings, the purchasing power of that money is being destroyed by inflation. Let's say you have $500,000 in your 401k today. And let's say you protect it and it's still worth $500,000 in 5 years. Great. Except that $500,000 in 5 years is only going to buy what $300,000 buys today. You preserved the number but lost the value. And that's assuming we don't get hyperinflation, which is a very real possibility if the government tries to print its way out of the next crisis. This is why I'm so focused on real assets. Gold doesn't pay interest. It doesn't grow, but it maintains purchasing power over time. If you had bought gold 20 years ago, you'd be up several 100%. Not because gold got more valuable, but because the dollar got less valuable. The same ounce of gold buys roughly the same amount of goods it always has. It's the dollar that's changed. And the dollar is going to continue to weaken as the government prints more and more money to service its debt and bail out the financial system. Now, let me address the counter-argument, because I know what the optimists are saying. They're saying the economy is strong, unemployment is low, corporate earnings are good, the market keeps hitting new highs. Why should anyone be worried? And here's my response. All of those things were true in 2007 too. The economy looked strong, unemployment was low, corporate earnings were good, the market was hitting new highs, and then 2008 happened and all of it fell apart. Because what looked like strength was actually fragility. It was built on debt. It was built on speculation. It was built on assumptions that proved to be completely wrong. The same thing is happening now. This economic strength is an illusion. It's being fueled by unsustainable deficit spending. The government is running trillion-dollar deficits during what's supposed to be a strong economy. That's insane. You're supposed to run deficits during recessions to stimulate growth. But we're running massive deficits during supposed good times, which means when the recession actually comes, and it will come, the deficits are going to explode to $3, $4, $5 trillion a year. And at that point, the bond market is going to revolt. Interest rates are going to spike, and the whole house of cards comes down. Corporate earnings look good on the surface, but dig deeper and you see problems everywhere. Companies are cutting costs to hit earnings targets. They're laying off workers. They're reducing capital expenditures. They're engaging in financial engineering, buying back stock to prop up share prices rather than investing in growth. These are not the actions of healthy companies. These are the actions of companies trying to survive in a deteriorating environment. And when the recession hits, those earnings are going to collapse. The stock market keeps going up, but it's happening on declining volume. Fewer and fewer stocks are participating in the rally. The advanced decline line is diverging from the indexes. These are classic signs of a market that's running on fumes. The last buyers are coming in, the stragglers who finally capitulate and decide they can't afford to miss out anymore. And that's always the signal that the top is near. When the last holdouts finally buy in, there's no one left to buy. And that's when the decline begins. Here's what I think is going to happen over the next 12 to 24 months. We're going to see a recession. It might start with a corporate debt crisis. It might start with a real estate crisis. It might start with a sovereign debt crisis in Europe or Japan. But however it starts, it's going to spread quickly. Credit markets will freeze. Banks will pull back on lending. Companies will cut costs and lay off workers. Unemployment will rise. Consumer spending will fall. Corporate earnings will disappoint. And stock prices will crash. The Federal Reserve will try to respond by cutting interest rates and restarting quantitative easing. But it won't work this time because inflation is still too high. They'll be trapped between trying to support the economy and trying to control inflation. They won't be able to do both. And while they're paralyzed, the crisis will intensify. More banks will fail. More companies will go bankrupt. More people will lose their jobs. And retirement accounts will get destroyed. By the time we reach the bottom, the S&P 500 could be down 60 or 70% from its peak, maybe more. Your 401k could be cut in half or worse, and it could take a decade or longer to recover. We're talking about a lost decade for retirement savings. A generation of workers who did everything right, who saved diligently, who followed all the conventional advice, and they're going to see their financial futures destroyed through no fault of their own. Unless they prepare now, unless they act before the crisis becomes obvious, unless they position their portfolios defensively and protect what they've built. That's why I'm telling you this, not to panic you, but to prepare you. Because if you wait until everyone else figures this out, it'll be too late. The time to act is now. While markets are still liquid, while you can still reposition, while you still have options. Once the crash starts, those options disappear. Don't be the person who wishes they had listened. Be the person who was prepared